as per our style. All right, good afternoon. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here with two great Bloomberg Opinion colleagues and economists, Karl Smith and Allison Schrager, to talk about Fed Day. Um, the setup for this one, I always try and make my intros kind of exciting, but here we have another decision that's almost certainly a foregone conclusion. The market widely expects the Fed to stay on hold here. We're also not getting a summary of economic projections, so I'm giving you all of the reasons up front to be bored with me. But the twist is we're going to be looking very closely for any kind of signaling, both in the initial statement from policymakers and from Chair Powell about how they're seeing the economy, sort of, right? The narrative is that everybody was expecting a recession earlier in 2023, and then the data started coming in really strong. Do policymakers see it as coming in too strong, potentially? And then, we want to sort of get a sense for how they are assessing financial conditions here. We've had this big run up in yields, notwithstanding, by the way, what has happened in like the last 5 or 6 hours, but we've had a big run up in longer term yields that is potentially affecting the economy and interest rate sectors, and we'll want to see how policymakers are thinking about that. Guys, you think I got that right there? What are you looking for, Karl, as we head into the decision in 3 minutes?
Yeah, so I mean, when I look at the data, especially since the last decision, it's become even more clear to me that I think this summer we had a turnaround in the economy and we were heading down in the first half of the year. And I think that the sort of third quarter big number is not as much, or not necessarily as much as of an aberration as people think. Across just about every series that we have, there's like a June, July inflection point, and it's going up. And so obviously this is a big number, and we would expect to come down in the fourth. But like there does seem to be some momentum. Does that get you to the point where the Fed is hiking? I mean, like I don't think so. I mean, I still think they're in pause, in part because it looks like some of the things that could be behind this would be positive. So productivity looks like it's going up. Wage costs look like they're still going down. Not quite as fast as we would like, but still going down. And so that points to better efficiency in the economy. And if that's what's happening, that's actually going to allow us to sort of like get out of this inflation tangle at a little bit lower cost than we might have thought of. So I think it's important, and I'm interested to see how the Fed thinks about the overall trajectory of the economy. I think it's going up, but I don't think that we should worry about hikes or anything like that, because of that. That's my best take.
All right, Allison, what are you thinking?
Well, I mean, like a lot of people, I'm concerned about the credit market. I think as markets are starting to realize that rates might higher for longer might actually be not mean like rates are going to be back to normal in a year or maybe even 2 or 3 years. And you have a lot of corporations that might need to start refinancing. I think sort of the concern for me is starting to look even sort of like when we say long and variable lags, coming off of a like very long period of zero rates for everyone refinance, those lags might be even longer than we thought.
That's interesting,
Yeah,
because Bill Dudley was saying that he thinks that lags are short now because the markets are, anticipate so well what the Fed is going to do that he sees the financial conditions index moving faster than like the actual like Fed funds rate.
Yeah, although the markets think the Fed knows what the Fed's going to do based on like no data surprises. I mean, I don't think even the Fed always knows what it's going to do.
Right, right. Mm.
yeah, it's so hard. I mean, it's so you really have to define your terms when you talk about financial conditions, right? Because I mean, like I think what the Bill Dudleys are talking about is like, you know, we start to anticipate rate hikes, and then bond yields shoot up. But like, look what happened over the past like 12 to 18 months. Like bond yields shot up, and then they came back down again, and then they went up again. Like, which financial conditions are we talking about, and over which period? I think is always a relevant question. We've got about 10 seconds until the decision. So let's get fired up here. All right. So as expected, the Fed stays on hold. Lower bound is 5.25%. Upper bound is 5.5%. Let's see if we can get some color commentary for you. So, reading the headlines off of our Bloomberg terminal. Fed is saying tighter financial and credit conditions to weigh on economy. Fed repeats it will assess the extent of additional policy firming. That language will assess the extent of any additional policy firming. Purposely squishy, right? They're not not telling us what they're going to do. Um, Let me pull up the handy dandy strike through comparison so we can get really in the weeds of how they've changed their messaging. And first blush, they haven't changed it very much at all. So changes to the first paragraph and the second paragraph. I'll give them to you word for word. Recent indicators suggest that economic activity expanded at a strong pace in the third quarter. Previously, this language was recent indicators suggest that economic activity has been expanding at a solid pace. So if you're the type of person that tends to make a big deal out of the change in adjective, too strong, get very excited. If not, hold your horses. After that, minor tweak to the sentence describing the job market. Job gains have moderated since earlier in the year. Previously, it said job gains have slowed in recent months. Again, you'll have to get up decoder to tell me exactly what the difference between moderating and slowing is, but to some people who make their living interpreting this kind of thing, might be something there. And I just want to add in the second paragraph, they do slightly tweak how they describe financial conditions. The statement used to say tighter credit conditions for households and businesses are likely to weigh on economic activity, dot, dot, dot. It now says tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. Go ahead, guys. I know you have your magic decoders. What does that mean?
So, I'd say, it's been a long time since I did real Fed speak stuff, but the impression is that what they wanted to move from is something that was saying that, like, the economy is going towards where, they wanted to. So when it's like solid pace, that's like solid is good. And then slowed is what they want. They want slower job gains. And so insisting to say strong and moderate, it means this is not necessarily good, or this is not necessarily what we think like should be happening, and we want to make it clear that no, this is a strong pace. Maybe could be too strong, maybe not, maybe not. And moderated means that like, it might not be getting there. You're right. You might not actually get to where we want it to get, which is a low. They want a low job growth rate because it'll be like consistent with inflation going down. So I think that's I guess what would slightly up your odds of, if you thought that there might be a hike, maybe if you think it's longer than longer, so higher for longer. Allison, what do you think?
I get that they're as clueless as the rest of us are. That actually they're like, why is the growth are we not having a recession anyway? Interest rates are up like a couple hundred basis points. It makes we're just gonna like hope this continues, and if anything goes wrong, we might raise rates again. So we're keeping that optionality open.
So
Okay.
what do you think financial is supposed to refer to? So maybe nothing, but like one thing I don't think I fully appreciate is how the regional bank story is supposed to bring down the economy. So I know what Bill Ackman, I guess, is saying that. How's that supposed to happen? Do you know, John?
Well, because they
No
do a
idea.
lot of the consumer lending, is
Got it.
that it? And
They do,
the
but I'm like,
and the
what's the story here? Like, because I mean, I know they've taken some losses on their portfolios or whatever. Are they saying that like, all sort of like commercial lending is coming to a stop? I mean, they don't control mortgage and stuff, do they? I mean, how's that go, Allison? Do you have any sense?
well, do they do the mortgages? I mean, I know they do a lot of sort of other kind of like commercial, like corporate commercial real estate lending and stuff like that. I mean, I think the issue is like no one's really asking for a mortgage right now because
Right.
the demand for it is just so low. So maybe that's not an issue yet. It's such a weird thing. Like, I feel like this is just a place we've never really been before, where we ended up with such low rates for so long, and then everyone refinanced, and so now everything's just sort of in this state of suspension. And like we might muddle through, I don't know, but like we don't really have a lot of history to go on because we've never really been in this place. Like in the 70s, when you had rates go from low to high, I mean, like people didn't have the same fixed rate mortgages that they do now. So it's just everything's so different.
Do you feel like bitter about those low rates? Sometimes I hear like, you're like, are you coming
No,
back
are
to
you
it? Oh, okay.
kidding? No, I bought an apartment like the week I closed, the week rates hit their record low. I am like delighted, personally, but I worry for the rest of the economy or people who weren't so lucky.
Well, yeah. So I mean, I think it's interesting that we have this effect where the market is locked up. And I mean, like if you'd asked me beforehand, that would be what I would have thought would happen. So I don't think it's really surprising that it did. It's just that we haven't experienced it, and so we don't know exactly what it's going to take to get it unlocked. And of course, we have a construction worker shortage, which is hurting new housing coming on board. That's what you think would solve it. So like existing housing is locked up. What happens? All the demand goes to new housing, and that's how the housing crisis gets solved. That's not happening because they have a shortage of construction workers. So then there is a question, about how we're going to get out of this. The thing to me though is that like I just see most of the paths towards a strong downturn like evaporating. That's why I'm like interested in this supposed regional bank story, because like it's getting just harder and harder for me to put together a story about how it happens, at least from right here.
So like the way I'm thinking about it is like I think we're like kind of in good shape, but we're not. But I think coming out of a dividend where we could take some bad things happening, like consumer balance sheets were in good shape, people had locked in low rates, but the more time goes on, the less resilient we become. And so I think we're in pretty good shape and we might muddle through, but if there's a shock or God forbid a resurgence of inflation, like we're in trouble.
Can I just say too, so a lot of discussion about the lock-in effect, whether it's like corporates terming out their maturities, or whether it's households households locking in great mortgage rates. But even in like sectors of the economy, like small businesses that are highly exposed to variable rate loans, like they're not crumbling, right?
Right.
And that's because consumption is still basically holding up, right? Like things are okay. Like to Allison's point, um, I'm not saying that they continue to do great if in an environment where interest rates go another 100 basis points higher, or any number of shocks hits us, but that takes everything down kind of all at once, right? But like this idea, and I think this is kind of both of your points to a degree. This idea that we're on like an inevitable trajectory towards recession without some negative outside force coming and smacking us. Like I don't think that's necessarily the case, right?
Yeah, and
Yeah.
I'm interested in what's going to happen with small businesses. I mean, my intuition is that like most of the economy, they just came in with such strong balance sheets, right? Probably, significant cash on hand. Yes, they have variable debts, but like probably their debt load is not that high. And that's even what we saw among sort of like working class families, like coming into this, is that they have credit card debt, but it was relatively paid down, so they're not as exposed to rising credit card rates. They had some cash on hand, and so it's making things more expensive, but it's not creating any sort of like tipping point yet. So that's I think that's the key. That's that people came in with such good stuff, and eventually that will run out. Like so, I've been I guess doing victory laps about how it's not run out yet, and I don't think it's going to run out soon, but it will eventually. So by the end of 2024, even I would probably say that balance sheets are probably going to be relatively normalized, and so we can't count on it anymore. But it's a long time away.
Yeah, I'm just way too superstitious to ever declare a soft landing because
Hmm.
you will never see me on one of those loops of economists getting it wrong and being like soft landing, and then like the next day there's a recession. Like I'm just too superstitious.
You
You'll never
you get
catch
you
me doing
got
it.
you got to put yourself out there. No guts to glory.
That's all right. Big swings. So shall we talk about wage pressures? That's always a big one here, and you can't have a conversation with a hawk here without discussing how the job market is still very tight. Um, we got the employment cost index yesterday. I believe it was yesterday, and measured quarter over quarter. I think fair to characterize it as basically flat.
Hmm.
Um, and so you, I guess the description here would be, we're not seeing a reacceleration, but you could read it as consistent with this idea that like the disinflation has run out of steam. Are either of you in that camp?
I don't know if I'm thinking that the disinflation has run out of steam. I mean, like, I didn't get to dig as deep as I wanted to, but roughly what I saw is, I mean, we looked like we had a big surge in, government wages. I'm not as ready to discount that, just throw it out because the government is volatile and these things build up and you have to account for them. But it did seem like private sector wages were on the same trajectory. And that's like the thing that I would think about. So if you thought they were on a slow glide path down, they didn't get off that path. And so I think that's telling you there still is, some wage disinflation that we're almost getting for free, right? We're not seeing an increase in unemployment. We're just seeing a decline in vacancies. And that seems to be working. And there is maybe a little bit more room for it to work. It's extremely hard to say because it's sort of like this vacancy expansion and contraction rather than unemployment is something that I'm pretty sure we've never seen before. Like I don't think there's anything even like analogous to it. So it's very difficult to say how long it's going to last, but it does not look like it's imminently tapped out to me.
Hmm.
What do you
Do you
think,
think
Allison?
like there's a story that I tell myself about the labor market and wages though, where it's like it just takes time, right? Because um, it was pretty clear that this inflation didn't start with wages. Wages kind of followed price, and so there was a period in 2022 or whatever, especially like bonus season 2023, where everybody was like, "Look, I just had a bad year. Like you gotta settle me up, right? I gotta play catch up so I can keep paying my family's bills and so forth. Um, and so like there's always going to be that lagged effect, and it's going to take some time to work its way through. But as long as it doesn't seem like that process is completely stopping, you stay patient with it, and you expect that it's going to continue. Do you think that's still a plausible story?
Yeah, I reckon so. I mean, I think firms will keep employing people as long as people keep buying things.
Mm.
And you know they'll probably inflation's lower, so there's no reason to increase wages as much. So is it it's like things could work out. It's just if people do stop buying things, then we're in trouble. And then, I mean, the labor market will soften. And I think it sort of becomes this sort of, I guess, virtuous cycle, is that I think consumers keep spending because they feel like the job market's pretty secure. So they keep spending, and that keeps businesses in code, and they keep hiring people. So far everything's good until it's not.
Yeah, I think you can get a lot of mileage out of just thinking that that Larry Summers was right, basically, about the beginning of the Biden administration, and we had an economy that was healing pretty well, and then we dumped a bunch of stimulus on it, and so it did what stimulus is supposed to do. It went out, increased demand, people shopped more, companies tried to hire more people, and it just got tight, and that's sort of easing out as time goes on, and that money sort of comes out of the system. That looks very much like what what happened, and I think it basically is. And I mean, it would be to the government to slow down spending, to really sort of put demand on a solid track. And I think that's where, I know you were thinking about where the deficit is and stuff like that. The deficit working through bond markets is something that I think is overwrought. It's probably not going to be a major effect like that, but it's that the federal government is still pumping too much stimulus for an economy that has this strong of a private sector, right? We went for a long time where basically, if a project was half decent, just fund it, right? Because interest rates are low, and we've got excess, unemployment, and so be less skeptical about it. But that's reversed, and I think it's very hard here in Washington for people to think in that way. It's been like the 80s, maybe in the 90s, since people were thinking about, look, resources are scarce, and we can't keep taking out of the private sector, or we're going to have this persistent inflationary bias to everything. And of course, that will lead to higher interest rates, but because the Fed needs to do that to squeeze inflation out, and not because, they can't move bonds. So I think that's where that happens.
How do you guys think Jay Powell is thinking about the deficit behind the scenes, right? Because he always gets questions about the deficit, right? And his default answer is, well, that's not my purview, and he has to say that. But I mean, geez, deficit spending mattered an awful lot during the pandemic, and it matters in this economy too. So how is he thinking about the way to conduct policy in this environment? And well, I guess I know what he would what he would be doing if he were actually designing policy over a treasury. But what do you guys think?
I think he thinks his lucky stars that he's probably not going to be Fed chair in 10 years, when we start having to pay for entitlements, and there might be actual political pressure to monetize the debt, and he will not be in that position where people will be concerned. But I think for now, I think he is worried, as Karl points out, of the stimulative aspect of sort of our fiscal policy. But beyond that, I don't think he's too worried about driving up rates and increasing our interest rate costs. But I think that's going to be a concern in the next 5 to 10 years.
I mean, I do know, for a period of time, I interact with those guys a little bit more, that just thinks about it in terms of the Fed kind of being put in a box, right? So if the federal government has more stimulus effect in good times, that makes it harder for them to keep interest rates higher. But also, if the federal government doesn't have the capacity to do stimulus in bad times, it also makes the job harder. So it's it's like Congress not being responsible for the debt just makes the Fed have to walk a more careful line. And the practical thing about that is that you're less likely to get the really sweet outcomes, because you can't risk it. You can't you've got to say, we've got to go ahead, and whether it's keep interest rates high, or be tight or whatever because we're afraid of inflation, or cut hard because of recession. We've got to go ahead and do the protective thing, and not wait for the sweet spot as long. You get boxed in like that. You have to react harder, faster, to whatever's happening, to be sure you don't get behind the ball. So I think that's really the problem that deficits at this point, present for the central bank.
Yeah. So putting all the pieces together, let me ask you guys, let's all put on our bond trader hats here for a second. A big story yeah, over the past 3 months, certainly, and since the Fed's last meeting has been this massive sell-off in bonds, especially longer term ones. A lot of people look at look at the 10-year. You can focus on the 30-year as well. That's reversing a little bit today, but one day's price action notwithstanding, like we saw all told like 100 basis point move in the space of like something like 3 months, so huge. So I guess I'd ask you guys first, what has been your story behind that move, and like second, are as the forces are aligning today, like does that feel overdone to you, or what's your story on 10-year bond yield at 5%? What do you guys think?
Well, I mean, everyone has their reasons why they think bond yields trended so low for so long, and I have a lot of reasons in my head, but like one of them that I go back to is just very thinking about it very classically, which is, long-term bond yields are a function of not only inflation expectations, but inflation risk. There's a big risk premium around inflation there. And I think we've sort of just awoken the beast that, inflation's a thing now. It's a risk that could come back. I don't think that's certainly all of it. There's also a lot of other things going on. Obviously, the Fed sort of signaling, no, we're serious about inflation. Debt concerns, of course, as Karl points out, that relationship's not clear because debt concerns have been around for like decades and no one seemed to care before, but markets don't care until they do one day. But I think the spark that got that was just sort of this sort of learning to live with inflation. And that, when inflation's a thing, bond yields, especially long-term bond yields, are just higher.
Right.
So you think this is kind of a loss of credibility on the Fed's part then?
Yeah, I think it's sort of, and I'm one of these people. I always believe that, like, and I was trained in grad school that, the Fed picks an inflation number and they just get it, and expectations are magic. And I'm starting to sort of really rethink that and think it was just sort of opportunistic disinflation that allowed them to sort of have that 2% target, which actually they were shot under. So I don't think they've ever actually gotten their target. But we could tell ourselves that they were in charge of inflation for a long time.
Yeah, I mean, my instinct is to think that something like this represents like a refiguring of what like the risks going forward are. And so I think before January, right, what you might have thought is that there was a decent risk that we were going to go straight back to low interest rates, right? That as soon as inflation went down, everything was just gonna return. That seems to be dissipating. And then on the other side, I think mainly actually China is the thing that like pushes you up, because if you have like a serious decoupling that comes from some sort of geopolitical like event, um, all of the things that gave the deflationary bias, right, were enhanced by like our strong trade relationship with China. And so that just sucks out like a lot of the deflationary bias that could happen year in and year out. And you might get back to a world that's like more normal, if there was decoupling. I'm not saying decoupling would be good in any way, but I'm just saying like when you saw, the United States in the position where you could have those extremely low rates, that was facilitated by, we have these massive credit markets, they have these massive manufacturing markets, they can work together, right? But like if to the extent that breaks down, then I mean, it's kind of anyone's guess, but it's also just makes it more likely that the pre-pandemic paradigm is gone and like cannot come back. And so that I guess is what I think is doing it, where they're like, okay, that's not gonna happen. And so that would be my guess.
Sure. And there's also, I mean, even under a relatively positive scenario, the fact of the matter is that we became sort of accustomed over the 10 years after the GFC to extraordinarily low, in fact, like emergency level interest rates, and that's certainly not happening again, even under the sort of status quo scenario. We would be going back to 2.5% policy rates, not whatever it was, the 1% that we averaged. Uh, Karl's
So at the
Karl's ready to
time,
give it to me. Let's
I
have it.
mean, look, look, at the time, I mean, I think, a lot of people were saying, from the Fed's perspective, I don't think the market ever bought this, but that like the natural rate is zero. Like that the natural rate of, real natural rate of interest in the United States is zero or like somewhere abouts. And because, demography is slowing, because, China provides this big manufacturing source, because we have this massive liquid credit markets. And when you add up all those factors, it seems absurd, but like that is what you get. And so that doesn't seem to be the case anymore. So like I do think there is a change. I do think that there was a possibility, that we would be, in the one range. I mean, maybe not, like just scraping the bottom of the barrel. I mean, look at Europe, right? I mean, I don't know how much their situation is permanently changed. I mean, they're kind of tracking a little bit up with us, but like uh, they were at the bottom barrel before us, and I think they're going to go back sooner. I mean, so I mean, it's certainly possible. Japan, was there for 2 decades, so it can happen.
Every every one of these ultimately ends in the debate about R star. I,
I mean, it's the key to everything, right? Like Woodford's like book or whatever.
right.
Mm-mm.
By the way, a slight digression. Much as I respect the opinion of every intelligent person who opines on R star, uh, my favorite intelligent take is that it is completely unknowable, and I know that Chair Powell shares that opinion, and his very first Jackson Hole speech was all about that. He had this all too sort of flowery analogy to the celestial stars and how uncertain they can be when using them in maritime navigation. But the fact of the matter is, it's very very hard to perceive this thing. But we have to talk about it anyway. So, Allison,
Mhm.
what has your take on R star been a moving target at all?
Yeah, I mean, I've always been someone who expected bond yields to go up, but I think R star is certainly really matters a lot for Fed policy, but actually, when it comes to the 10-year rate, to some degree, I'm more interested in what's driving the term premium because I think of R star as being the Fed policy rate. So the term premium on top of that, I mean, we could still be. I don't personally think we are, but we could sort of having like a 5-year, 10-year for the next, like be our equilibrium interest rate for the next like decade is totally consistent with still having a 0 R star. Just if you said if we have larger term premiums, I mean that could happen. And for consumers, I mean the 10-year into some ways is a lot more relevant.
So you're saying the policy rate could be zero and the 10-year could be 5?
Yeah.
I mean that's a hell of a premium. I mean like I see that seems unsustainable, and if that kept
Why?
happening, huh?
I mean, they call it a term premium for a reason. And if people are nervous about yields going up because they said we have unsustainable debt, or like if we have another big inflation spike and the Fed isn't good at getting it down, then all of a sudden we have a lot of inflation risk in there. I mean, it's not outside the bounds of what we've had historically.
Yeah, I don't know. I mean, it does seem big for a historical thing, but I'm also thinking that like if you consistently have a low policy rate, right, that's going to bring down your sense of like what the risk is for like the out years. So like if the
Not
policy
if
rate's
you
moving like
don't.
this, then like yeah, then like you're going to have a bigger on the out years. But if it's come down close to zero, that should squeeze like the term premium. You see what I'm saying? Like the
Yeah,
more it's moving like this,
if you
yeah.
believe if the Fed's credible.
Right, that's true. That's true. So yeah, I mean, it kind of comes back to that. If Allison's thesis is that the Fed never should have had the credibility that it did, that they got lucky, and people are realizing this, then that I can see that. That makes sense to me.
Okay. But largely, largely a question then about credibility and volatility, right?
Right.
Yeah, yeah, that makes sense. Just to put a bow on that for everybody, uh, so the term premium is like squishy everything else category when you're thinking about sort of the outlook for long-term bonds. So you have some sort of expectations of where policy rates are going to be over a time horizon, maybe a 10-year time horizon, and that includes some expectation about inflation. So we might say we think the average policy rate will be 3% over the next 10 years, and that would tell us something about where the 10-year yield should be. But anything above and beyond that is term premium, squishy other stuff. So with that, I do want to start with the squishy other stuff characterization. I do want to start winding down because we are going to have Pal coming on in just a few seconds. And I want to let people move over to that. But I want to thank very much